Yeah, good afternoon, everyone. It gives me immense pleasure to welcome you all to this important webinar organized by AASB, focusing on SA 200, overall objectives of the independent auditor, and the conduct of the audit in accordance with standards on auditing. As we all are aware, that SA 200 forms the foundation for the standards on auditing framework, and it also provides the overarching responsibilities of the auditor in conduct of the audit. As a sound understanding of the standards is very crucial to our every audit professional to ensure the high quality audit and the consistent and ethical audit practices. So we have invited the our one of our sought after speaker, CA Dhananjay Gokhale, who has graciously accepted our invitation, and to all the participants for sparing their valuable time to be the part of this knowledge sharing initiative. We would like to convey our heartily thanks to them. So, since I'm confident that the today's deliberation will be insightful and enriching for all of us, I would like to hand over to our speaker without wasting much of the time, so as to start the technical proceedings of the session. I would like to give a brief about our speaker also. CA Dhananjay Gokhale is a senior chartered accountant with over 28 years of the professional experience. He is a founder of partner Dhananjay J. Gokhale and Company, specializing in the management consultancy and auditing, particularly in the corporate and the banking sectors. He has served as a co-opted member and the special invitee to the Auditing and Assurance Standards Board, and also to the for multiple years, and also to the various study groups and the other committees of the ICI. He has contributed to the various ICI publications, including the Bank Guidance Note on Auditor of Banks and the Manual for the Concurrent Auditor. He is one of the amongst very popular speaker, as I told. So he regularly delivers sessions at the ICI seminar as well as the RBI, College of Supervisor, NABARD training, and the other various banks and the cooperative association across India. Currently, he is working on our various publications like Guidance Note on Auditor of Bank, the Guidance Note on the Urban Cooperative Banks, and other technical literature related to standards on auditing. I welcome you, Dhananjay Gokhale, sir, to deliver this session of today. Thank you, everyone.
Yeah. Thanks a lot, Megha, for introduction and starting off the session. And my apologies to start a little late. And unfortunately, my camera is not working. So again, apologies for that. I will share the screen first, and then we'll start with the presentation part. Just a minute.
Sure, sir.
Yeah, it's visible.
Yes, sir. It is.
Yeah. So good afternoon, everybody, and it's a pleasure to address on the Institute Forum, especially about the SA 200, which is always called as mother of all standards on auditing. And the peculiarity about SA 200 is that it doesn't specifically talk about how to do the audit, but it sets a kind of a background or a precedent to comply with all the standards on auditing. So when we talk about this SA 200, what we need to keep in mind is, unlike other standards on auditing, which typically talk about the procedures to be followed and certain guidelines which are given as far as certain aspects of audit is concerned. Unlike that, SA 200 sets a starting point for all the standards which are required to be complied by the auditors. Now, before we really get into other nitty-gritties, a couple of things which I just wanted to highlight over here is, when we talk about anything which is called as a standard, that is something which is mandatory on the part of the auditors to comply with. As compared to that, if you talk about, say, standards on, accounting standards, similarly, a guidance note, there is a subtle difference between a guidance note and if you talk about the standards. Guidance note per se are not really mandatory. I'm saying about the technical part. So in case if the auditor wants to deviate from a particular guidance note, he can definitely do that by recording his reasons for deviating from a particular stand which is taken in a guidance note. But unlike that, typically auditor is not supposed to deviate from standards. In the sense, all the standards are required to be complied in toto without any deviations. The only difference is that, or the only deviation which I can talk about is, in standard, if there is a specific procedure which is given to be followed by the auditor, and if that procedural part is not possible for the auditor to follow for any reasons, he can have an alternative mechanism worked out, and that's how he can comply with the requirements of standard. One more thing is that as far as the standards are concerned, typically standards on auditing, they are more to give guidance to the auditors and also to ensure that the qualitative aspect of the audit is maintained. So one has to interpret all the standards in a logical way and to after keeping in mind that what is the purpose of every standard. So I just thought that to just give a little background about what is standards and other things. Now let's come to the presentation about ASA 200. So just an overview of ASA 200 before we really start off. As far as SA 200 is concerned, firstly, if you look at the standard, the structure is that initially in introduction part, the scope of standard is specified. Then the audit of financial statement where the standard will apply is specified, the effective date is specified, which is 2010. Then overall objectives of the auditor are specified. Then couple of definitions are there which are relevant as far as this standard is concerned. Those are given. And then there is a requirement part about the standards on that is SA 200 about which are the things which are required to be complied, and then application and other explanatory material is given. So we'll try to cover all these things in today's presentation, and at the end I will like to have some examples given, a few illustrative examples I should say, as far as SA 200 is concerned. Now first thing, let's talk about what is the scope of this standard. Now, as far as the scope of this standard is concerned, this standard is to establish the independent auditor's overall responsibility when he's conducting the audit of a financial statement. Now, when we talk about the independent auditor's overall responsibility, it will also, include what should be the scope and authority and structures of other standards on auditing, and it also sets general responsibilities which are there on the auditor. And it is obligatory on the part of the auditor to ensure that all the standards are complied. And all the standards, when we say that these are required to be complied, all the standards are required to be complied in toto, and all the standards are not required to be bifurcated from each other. So it's a kind of a comprehensive network or a comprehensive structure of standards which the auditor has to ensure that he is complying with the entire structure. And he should not be looking at a particular standard in isolation. In fact, if you look at all the standards, actually, they are correlated and interrelated with each other. So we cannot isolate a particular standard and say that only this particular standard is required to be complied. There is always a correlation between all the standards with each other. Now, as far as audit of financial statement is concerned, just to give an example of audit of financial statement, what is called as a financial statement, so firstly the auditor should be very clear about what is a financial statement. So let me just give you a simple example of what comprises financial statement. Typically when you refer a term as a financial statement, it will typically comprise of 4 or 5 things. Firstly, the balance sheet. Second one is profit and loss account. Third one is cash flow wherever it is applicable, and fourth one is the notes on accounts and accounting policies disclosures. That is a disclosure part. Now all these 3-4 things together, comprised together, will form a statement which is called as a financial statement. Now as far as the audit of financial statement is concerned, now let's come to the basic point why audit of financial statement is really required. Because one of the reason for that might be that the statute really requires for doing an audit of a particular financial statement. So if you're talking about say a Companies Act, naturally for private limited and public limited and all companies, the audit is essentially specified to be conducted. If you talk about a proprietorship, irrespective of the turnover, let's presume that it's a proprietorship, a minuscule proprietorship having say a turnover of only 10 lakhs. But still, if the proprietor requires, naturally the audit can be undertaken. Now, what is the reason, why audit is really required or why the audit is preferred for a financial statement? The reason is that the audit enhances the degree of confidence in the financial statement. So typically when we refer to the various users of financial statements, if you distinguish between an unaudited financial statement and an audited one, naturally the user will have more degree of confidence over the one which is audited. Now, who are these users of financial statement? So typically when we talk about the users of financial statement, it can be stakeholders. So if you talk about say a private limited or a public limited company, the shareholders of that. If you talk about the society, members of the society. If you talk about say partnership firm or LLP, the partners of that. So all these are stakeholders in that particular entity. So That can be one of the one of the users of this audited financial statement. Other users might be regulatory authorities, maybe tax authorities, maybe regulatory authorities like say RBI, SEBI. There might be other users also. For example, the investors who might be using that financial statement for taking a decision as to whether to invest in a particular entity or not. There might be other class of users like say investigative agencies who might be referring to a financial statement irrespective of whether the financial statement belongs to that entity where the investigation is on, or it can be a related party, or it can be a third party, but which is having a transaction or some relation with the underlying entity. So there are multiple users of financial statement. Now if a financial statement is audited, the user will get a higher degree of confidence in the financial statement. The reason being, typically, why that high degree of confidence will be there? The reason is that there is an independent agency called auditors who are expressing an opinion about the financial statement, and that opinion is something on which the reliance will be placed. Now, when we talk about the audit of financial statement, the expression of opinion is naturally there. Now, as far as the preparation of financial statement is concerned, the opinion will be given based on one basic thing, that whether that financial statement is prepared in accordance with the applicable financial reporting framework or not. Now, what is financial reporting framework? It is a typical set of regulatory norms which apply in preparation of financial statement. Now, that financial reporting framework will also include certain additional parts, need not be limited only to say balance sheet, profit and loss and other things. At times the regulatory authorities might be specifying certain additional disclosure requirements over and above what is required to be there as per the accounting standard. So just to give an example, if you talk about say typically a bank audit, in bank audit, what we will ensure is that whether the profit and loss and balance sheet, whether it is prepared in accordance with the format of balance sheet and profit and loss account given in the Banking Regulation Act. Over and above that, RBI circular warrants certain additional disclosure requirements, which are in addition to what is specified in the Banking Regulation Act and what is specified in the accounting standards, which are applicable to a particular entity. Now, all these things will also be combined together when we call a term that is financial reporting framework. Now, what one has to really ensure is that when these financial statements are prepared, one should not be under a false impression that it is going to comment upon the viability of that entity in future and other things. So what one should ensure is that the financial statements which are prepared or the audit which is undertaken on a financial statement, they will not be ensuring that there is a future viability for the entity. And secondly, typically the audit will not comment upon the efficiency and effectiveness of the management. Now, there is a slight, I should say, not a deviation per se, but slight, one more thing which one has to factor into that. When typically a statutory auditor is, commenting upon internal financial controls over reporting, to certain extent, he is commenting on the efficiency and effectiveness of the internal controls which are implemented by the management of that particular entity. So when you comment upon the IFC, to certain extent, you talk about the efficiency and effectiveness of internal control also. Secondly, the standards per se will not impose a responsibility on the management or those charged with governance to comply with standards on auditing. Now, what does this really means is, as far as standards are concerned, they are mandatory, they are obligatory on the auditors to undertake and comply. But there is no responsibility of the management or those charged with governance to comply with standards on auditing. So standards on auditing per se will relate to the audit function and they are not related to the auditee per se. Second, most important thing is that a standard on auditing cannot override the laws and regulations which are applicable to a particular entity. So suppose you have specific guidance given in a particular standard, and if there is a adversity, or you can say a different view which is taken in the law and regulation which is applicable to a particular entity, naturally the standard should not be applicable. So standards on auditing can not override the laws and regulations which are applicable to a particular entity. Now, when auditor expresses an opinion, he will be giving a reasonable assurance. Now, what does that really means? Now, it means that auditor is not giving you an absolute assurance. he is giving you a reasonable assurance to the extent that he is confirming that he has obtained sufficient and appropriate audit evidence, and it is reducing the audit risk to an acceptable low level. So no one can guarantee 100% assurance, for any purpose. Same applies to the auditor also. So under the existing audit framework, the expression of assurance or the assurance which is given by the auditor has to be a reasonable assurance and not absolute assurance. The practical aspect over here is absolute assurance is something which is impossible because of certain inherent limitations which are there in the audit. And one more important thing is that whenever the auditor is using his professional judgment, he has to ensure that the materiality angle is also applied at the planning stage and also at the performance stage. Now let's look at this planning stage and performance stage from materiality angle. And as far as this materiality angle is concerned, it will change from entity to entity. It cannot be applied in a uniform manner for all the entities. So depending upon the type and structure of the entity, depending upon the complexities of the transaction which are undertaken by the entity, the auditor will plan as to how to perform the how to do undertake the audit, and the actual performance will be based on that planning. Mortality is something which the auditor has to decide based on his professional judgment, and it cannot be objectively defined. It's a subjective concept, but one has to apply the professional mind to decide about what is the mortality, and that mortality aspect has to be applied in a planning and performance level also. Now, certain things, like as far as the audit evidences are concerned, then few things which one has to keep in mind. First thing is that the audit procedures are required to be used by the auditors to ensure that he's gathering the sufficient audit evidences. And when the sufficient audit evidences is gathering, he need to ensure that the audit evidences which he has gathered, whether they are sufficient and appropriate for the function of his audit or not. Many a times it might happen that the management and those charged with governance may not provide a complete information, either intentionally or unintentionally. Now, what is the duty of the auditor over here is he has to first understand that what kind of information he requires, and whichever information is provided by the management to the auditor, whether it is sufficient and appropriate or not. Now, there is naturally a completeness check which the auditor has to undertake. He has to also undertake sufficient, cross checks to ensure that the data or the documents or the information which is provided to him, whether it is complete, whether it is as required by him and as requested by him. There might be instances wherein the management has unintentionally provided maybe a partial data or a partial information. So the sufficiency check and the completeness check has to be undertaken by the auditor. Second thing is that the audit procedures which are used for gathering of the audit evidence at times may not be effective, to have a fraud detection, mechanism. Now, what is important over here is that the audit function is not to detect the fraud. So it's not an investigation function. Under no circumstances, auditor should be, having a biased mind, or I should say, having a mindset wherein he is getting into an investigation for some allegations related to wrongdoings by that entity, or maybe by the management or those charged with governance. Second important thing is that auditor per se doesn't have a specific legal power to undertake a search. Now let me just correlate that with what are the powers of the auditor. Now, frankly speaking, the auditor has powers to ask for any information, any data. He can visit that audit is place at any point of time, and whatever information which he feels that which is required for the conduct of his audit, he has every right to get that information. But at the same time, we need to balance that expectation, or I should say powers of auditor, about the powers of searching a particular area or a particular premises. So the powers which the auditor uses is to gather the data or to get the sufficient and appropriate audit evidences. It is not like an investigation wherein a search function is really carried out by the auditor. One more thing which is very vital is that when we always talk about the auditor has to perform his duties and he has to obtain sufficient and appropriate evidence, he has to express the opinion and all these things. Many a times there is a difficult task for the auditor to balance between the cost and benefit. So many a times the cost which is involved to obtain sufficient and appropriate audit evidence may not be really having a correlation with the benefits which the auditor is deriving. So whenever audit procedure is set, whenever the audit planning is done, auditor has to keep on weighing between the cost and benefit whenever any audit procedure is undertaken. Second thing is that as far as the cost and benefit concept is concerned, may be exceptionally high cost which the auditor has to incur to perform a particular audit process. It cannot be a valid reason to omit a particular audit procedure. So wherever there is no alternative audit procedure is possible, and wherever there is a less persuasive audit evidence which is made available to the audit cannot take a shelter by saying that I won't perform a particular audit procedure, for maybe it was difficult to perform that process, or maybe the time and cost involved was too high as compared to the benefit which has derived. Only option which probably is available to the auditor is that he can perform an alternative audit procedure which is equally effective to the original audit procedure which was sought by the auditor or which was specified in the applicable standard on auditing which was related to that particular procedure. Now let's come to the point about what is the objective of standards on auditing. Now the reason why standards are there is all the standards are designed in such a way that will support the auditor in obtaining a reasonable assurance. Now, again and again, I'm repeating the word reasonable assurance because auditor per se cannot really give absolute assurance, and that is something which is not possible for a human. Now, typically, what is expected from the auditor is that he has to ensure that he's exercising the professional judgment whenever he's undertaking any audit procedure. He's maintaining the professional skepticism. Now, what is professional skepticism? If you talk about the professional skepticism in simple words, what I can explain is that auditor has to keep his alertness alive throughout the audit process, and secondly, he need to have his questioning mind, alert mind intact throughout the process. Just to put it in other simple words, when we say that we have to have a professional skepticism, what it really means is you should not blindly rely on someone, or you should not rely blindly on some representation which is done by the management of the auditing to you. You need to have alertness intact. You need to be having a questioning mind wherein you need to ensure that whatever evidences are produced before you, unless and until you perform certain procedures, unless and until you question certain parts of that, you should not blindly rely on that. So you should always presume that there is a chance of error. The error might be intentional or unintentional. So anything and everything which you see during the audit process, you need to ensure that that is accepted with a pinch of professional skepticism. Second thing is that the auditor has to identify and assess the risk of material misstatement. He has to obtain the sufficient and appropriate audit evidence about the material misstatements which are there, which are probably are likely to be there. He has to design and implement the appropriate responses to the assessed risk. And last but not the least, auditor has to form the opinion on the financial statements which are based on, that is, the opinion has to be based on the audit evidences which he has gathered throughout the audit process. So these are the expectations from the auditor. What is the overall objective of the auditor is that he has to obtain a reasonable assurance as to whether a financial statement is free from material misstatement. Now, when I say financial statement, I need to look at the financial statement as a whole and not in componented form. And when I say talk about the material misstatement, let's bifurcate that into a couple of points. Now, first thing is that when we say about the material misstatement, it might happen that there are certain misstatements which are included in the financial statements in certain things which are not material if you look at the individual items. But if you combine all these items together, it becomes a material amount. So in that case, the auditor has to look at the financial statement as a whole and not components of financial statement in isolation. So what auditor has to give a reasonable assurance when he's issuing the report is that he has to say opine as to whether the financial statements as a whole are free from material misstatement. And material misstatement might be due to fraud or due to error. It is irrelevant of that. He has to give assurance about that the financial statements are free from material misstatement. As far as the reporting is concerned, the reporting on financial statements and communication will be required to be done as per the standards of auditing. Just to give an illustrative example, the SA700 series is the one wherein the reporting requirements are spelled out as to how the auditor will report, how the auditor will report in case wherein there is a material misstatement, when there is no material misstatement. So all these are there in SA700 series. Now let's come to the definition part, because the definitions are fairly important as far as this SA200 is concerned, and all these definitions are comprehensively required in multiple standards. So let's start with the first one, that is applicable financial reporting framework. Now, by definition, what it means is this is the financial reporting framework which is adopted by the management or those charged with governance in preparation and presentation of a financial statement. And this FRF, that is financial reporting framework, is acceptable in the view of the nature of the entity. It should be acceptable with the objective for which the financial statement is prepared, and it should be as per the requirements of law and regulation. Let me give a simple example about applicable, financial reporting framework. As I said earlier, suppose you are talking about, say, a banking entity. The financial reporting framework will be governed by the Banking Regulation Act. The format of financial statements which is specified in the Banking Regulation Act. As compared to that, if you talk about the company registered under Companies Act, the financial reporting framework as per the Companies Act will be applicable. Let's take an example, say, of a cooperative society. So there is a reporting framework which is designed in respective Cooperative Societies Act, which are applicable to that society, that will govern. If you talk about, say, a partnership firm or a proprietorship, there is no specified financial reporting framework. But recently, as all of you are aware, there is a guidance note which is already issued by ICA about the entities which are not audited. That is typically such entities, wherein the reporting framework is also not defined. Second is definition is about a fair presentation framework. Now, in fair presentation framework and compliance framework, the basic difference is that in fair presentation framework, what is required to be achieved is, in the fair presentation framework, that it acknowledges explicitly that it is essential for the management to depart from the requirement of the framework to achieve a fair presentation framework, in certain rare cases. But in general, if you talk about fair presentation framework is the one which is required to be complied with. Now, as compared to that, the compliance framework might be applicable in certain cases. Now, when you are talking about compliance framework, in these cases, it may not give a true and fair view because it's having altogether a different framework. So, auditor has to first verify as to whether the fair presentation framework is applicable to the particular entity or whether it is a compliance framework, which is applicable. Next definition is about the audit evidence. Now, audit evidence will include any information, any material, any data which is used by the auditor to arrive at the conclusions on which the auditor's opinion is based. Now, this audit evidence is, I should say, it's a larger concept. It will include both information which is contained in the accounting records underlying the financial statements and any other information. So just to give an example, suppose you have accounting records which are maintained in, say, Tally system, and that particular entity is maintaining records related to stock in a different software. It is maintaining, say, records related to, say, fixed assets in another software or maybe in Excel sheet. Now, all these records per se may not be called as accounting records, but all that other information which is made available to the auditor will be called as audit evidence. Let me go a little further. So, for example, if you talk about, say, AS15 retirement benefit, there might be actuarial valuation. If you talk about the revaluation of fixed asset which is done, there might be a valuation report. So even this actuarial report or valuation report, all these will form part of your audit evidence. So it is not only confined to accounting records or vouchers per se, but it can be much more and beyond that also. Sufficiency is defined as it's a measurement of the quantity of audit evidences. So when we talk about sufficient and appropriate audit evidence, so a minimum quantity of audit evidence which the auditor feels sufficient has to be achieved while confirming that the sufficient and appropriate audit evidence are obtained by the auditor. Appropriateness, the word, it indicates that it measures the quality of the audit evidence which the auditor has gathered, the degree of reliance which he can place on the audit evidences which he has gathered. Now, it will be pertinent to note the definition of audit risk. Now, audit risk, how it can be defined is the auditor expresses an inappropriate audit opinion. That is one of the risks. So, auditor may have misjudged something. He is not able to have a fair judgment on the appropriateness and sufficient audit evidence, or maybe the underlying audit evidences which are made available to him, he is not able to draw a conclusion from that. So one of the audit risks is that he expresses an opinion which is inappropriate. It is not the right opinion. Second thing is that sometimes the financial statements might be material misstatement, but the auditor might miss out on that. And the audit risk is a function of the risk of material misstatement and detection risk. That is, at times he might fail to detect a risk of material misstatement. He might, at times might have oversight on the material misstatements which are there. So that's an inherent audit risk which naturally will be carried. Definition of auditor, I think it need not be really gone into the depth. So auditor means any person who is conducting the audit. It will include the engagement partner. It will include any member of the engagement team, or maybe the firm per se. And where the standards is expressly specifying that there is a requirement or responsibility to be fulfilled by the engagement partner, then the auditor term will be replaced by the term as engagement partner. Detection risk, we already talked about, that a risk which is possibly arising out of the procedures which are insufficient to detect a material misstatement risk. And when we talk about the material misstatement, the materiality has to be considered either individually and also on an aggregate basis. So it's not in isolation. You should distinguish between the components of financial statement and say that, but all these components are materially, they are individually not material, but you need to also aggregate that, and you need to see that whether the materiality exists at the aggregate level or not. Now, let me just give you a couple of examples. Like, for example, let's take an example of, say, a big entity having a turnover of, say, 1000 crore. Probably, as far as the materiality standard is concerned, maybe 5 lakh rupees might not be a material amount, as per the auditor judgment. But suppose there is an entity having, say, 1000 crore turnover or maybe 10,000 crore turnover, but the profitability of that entity is just, say, 3 lakhs. Now, in that case, that 5 lakh amount will also become material. So the judgment of materiality has to be done by the auditor based on the financial statements on various parameters, and it has to be seen individually and also in aggregate form. Now, financial statement definition, technically, if you look at the definition, it is a structured representation of historical financial information which includes the related notes, and ordinarily it will comprise a summary of significant accounting policies and other explanatory information. And the financial statements per se are intended to communicate that entities, that is auditors' economic resources or obligations at a particular point of time, that is a cutoff point. So if you are preparing, say, for a financial statement, 31st March might be the cutoff point. And secondly, the changes therein for a period of time in accordance with the financial reporting framework, which is more particularly about the profit and loss account. What is historical financial information? It is a information which is expressed in financial terms in relation to a particular entity. Typically, this information will be derived from the entity's accounting system. But when I say primarily or basically, what I mean to say is that it is a prime source, but there might be additional evidences also beyond the accounting system. It talks about the economic events which are occurring in the past time period, or it also will include the economic conditions and circumstances at the point in time in the past. Management is defined as persons with executive responsibility for the conduct of entities' operations. And for some entities in some jurisdiction or in some frameworks, management will also include some or few people who are charged with governance, Like say in case of a governance board, all the members of that governance board, at times there might be owner and manager, both will get included. It will entirely depend upon how the structure of that audit entity is. So at times the management need not only include the top management or maybe only directors, but it can also include maybe second or third line of hierarchy also. Now, misstatement is defined as difference between amount, classification, presentation, or disclosures of a reported financial statement item and the amount, classification, presentation, disclosure that was required to be made in accordance with financial reporting framework. And there might be a misstatement, there might be a deviation which might arise out of fraud or it can be arising out of an error also. So it can be intentional or it can be unintentional also. In case of a fair presentation framework, it will also include the adjustment of amounts, classifications, presentations, disclosures that as per the auditor's judgment are essential for the financial statement to be presented in a fair form in all material respect, or in other words, to give true and fair view to the financial statements. As far as premise relating to the responsibilities of management or those charge governance are concerned, based on which the auditor conducts the audit, there are fundamental responsibilities, which are there on the management or those charged with governance. First responsibility is that they have to prepare and present the financial statement in accordance with the applicable financial reporting framework. This will include the design, implementation, and maintenance of internal control system to ensure that the presentation is a fair presentation framework. They have to also provide the auditor with all the relevant information which was relevant as far as the preparation and presentation of financial statement is concerned, and any additional information which is requested by the auditor, they are duty bound to provide that. They have to give unrestricted access to the auditor within the entity, and this applies to the fair presentation framework. Professional judgment is application for training, knowledge, experience within the context which is provided by the auditing and accounting and ethical standards to reach the level of making an informed decision about the course of action, and those are appropriate in circumstances of the audit engagement. Professional skepticism, we already talked about that. The auditor should have a questioning mind. He has to be alert with the conditions which probably might indicate that there is a possibility of misstatement due to error or fraud. He has to have a mindset to do a critical assessment of audit evidences. So that's a professional skepticism. Reasonable assurance is also defined. Reasonable assurance in the context of an audit of financial statements is high but not absolute and level of assurance. In the sense, when someone is giving a reasonable assurance, it's a high level assurance, but you cannot say that it's 100% assurance. So it's not absolute assurance which one is giving. And again, to repeat, the auditor can only give a reasonable assurance, and giving absolute assurance is something which is prohibitive. Risk of material misstatement, we already talked about that. The risk will include the financial statements which are material misstatement prior to the audit, and it consists two components at the assertion level. One is inherent risk and second one is control risk. Now, when we talk about the inherent risk, there is a possibility that either at individual level or aggregate level, before consideration of any related internal control system, there is a possibility that the amounts might be, say, recorded wrongly, or maybe there is a material deviation from the accounting standards also. As far as control risk is concerned, this is the risk that the misstatement that can occur at the assertion level, at assertion that could be material, either individual or aggregate, and it might not be prevented or detected or corrected on a timely basis. So that's a control risk. So what is the difference between these two? Inherent risk are something which can be controlled, which can be kept under control by way of using the internal control mechanism in a particular entity. So control risk is concerned, there might be a lacuna in entity's internal control system, which might lead to a circumstances wherein there is a material misstatement. So both these risks are required to be considered by the auditor while undertaking the audit of a financial statement. Though charged with governance, a very common term which is used. these are typically persons or organizations as a corporate who are having the responsibility for overseeing the strategic directions of the entity. They are having obligations related to accountability of the entity. They are also, having a responsibility to oversee the financial reporting process. So these are the people who are called as those charged with governance. Now let's come to the second point about the ethical requirements relating to an audit of a financial statement. Now, first and foremost thing is that the auditor has to comply with the relevant ethical requirements related to an audit of a financial statement, which primarily will include the independence. Now, independence is, you can broadly define that independence of mind and independence in appearance. In the sense, the auditor should ensure that he is maintaining the high degree of independence. He is not getting biased. He is not getting influenced by any representation which is made before him. Second thing is that he is maintaining the high degree of independence as far as the correlation of other things are concerned. Just to give an example, for example, suppose there is an auditor who is having, say, a relative working in a particular entity, maybe at the highest level. So naturally, even though he is not financially involved in that particular entity, he needs to ensure that as to whether it is possible for him to maintain independence in that particular entity or not. Second thing is that the auditor has to safeguard his ability to form an opinion without being influenced by compromising factors. So one has to have a policy design which ensures that he is not getting compromised while forming an opinion because of various factors, like maybe taking some additional assignments which are probably affecting your integrity and independence in audit. Auditor has to also ensure that he's very objective in terms of performing his audit function. He has to ensure that he's maintaining his professional skepticism, and he has to always ensure that he's enhancing his ability to act with integrity. Now, as far as professional skepticism is concerned, that has to be factored in while planning the audit and while performing the audit also. So just to give an example, suppose you are a continuing auditor and say last year you're having a last year experience that, let's say, in godown A, the stock which was kept in a proper form. There was essential and effectiveness of internal control which was existence in that place. So you should not presume that the same thing will continue in the next year. So you should not be blindly relying on something. You need to have a kind of a questioning mind. You need to have alertness which should be always alive. So all these things which are factoring the professional skepticism has to be kept in mind when you plan as well as when you perform the audit. Second thing is that this alertness is essential when you are doing a critical assessment of the audit evidence. So, for example, suppose you presume that out of, say, four persons who are dealing with you at a particular audit place, say A, B, C, and D, you have past experience that whatever evidences are given by A, B, C, and C, they are always proper, they are adequate, and they are highly reliable. Now, under this presumption, you should not ignore the criticalness in assessment of the audit evidence in the next, audit period also. You need to have unbiased view. You need to be always alert, and it should not be person specific or it should not be location specific. And you need to follow the procedures which are uniform and which are without any biasness. Now, because of keeping professional skepticism, what are the benefits? It will naturally reduce the risk of overlooking an unusual item or unusual circumstances. It will reduce the risk of overgeneralizing while drawing conclusions from audit observations, and it will reduce the risk of inappropriate assumptions in determining the nature, timing, and extent of audit procedures and evaluating results thereof. So you should not get influenced by anything. You should keep your alertness alive, at all the time. You need to also apply your professional judgment when you are doing the planning of an audit and when you actually perform that particular audit. And the expectation from the auditor is that he is exercising the professional judgment and he is having training and sufficient knowledge, and he's having a experience which is getting from his assistants. He is essentially developing the necessary competence so as to enable him to apply the professional judgment, and he needs to ultimately ensure that he is able to achieve the reasonable judgments. Now, the exercise of professional judgment will depend on the facts and circumstances which are known to the auditor. Something which is unknown, something which is maybe intentionally kept hidden from the auditor. So these are the things wherein practically the auditor will not be able to really apply his professional skepticism and judgment if something is not revealed to him. One can evaluate the professional judgment based on whether the judgment is reached, judgment at which he is reaching, whether he is reflecting, it's reflecting a competent application of auditing and accounting principles, whether it is appropriate in the light of consistent with the facts and circumstances which were known to the auditor till the date of audit report, that is till the time he is issuing the report. He has to ensure that his professional skepticism and judgment is exercised throughout the audit. He has to appropriately document wherever he is taking a professional judgment about forming an opinion on a particular point. And last but most important thing is that professional judgment cannot be used to justify the decisions which are not otherwise supported by the facts and circumstances of the engagement or which are forming part of sufficient and appropriate audit evidence. Auditor cannot take a professional judgment, or he cannot take a shelter of professional judgment that he felt that as per his judgment sufficient and appropriate audit evidence was not required. So that is something which is essential for a performance of audit, which cannot be overruled or which cannot be overridden by the professional judgment of the auditor. Now let's come to the sufficient and appropriate audit evidence and its correlation with the audit risk. Now, what is meant by sufficient and appropriate audit evidence is, if you talk about appropriateness is the measure of quality of audit evidence in terms of its relevance and in terms of its reliability. When we talk about the sufficiency and appropriateness both are interrelated with each other. Now let's take an example. Suppose you're checking on a particular, say, evaluation report which is provided by a approved valuer. Now, as far as the qualitativeness of the audit evidence is concerned, a auditor might be having a professional skepticism applied, and he is not able to decide as to whether it is a reliable audit evidence or not. Now, there are ways and means to overcome that also. For example, the auditor might engage the services of auditor's expert, and based on that, he will decide whether the quality of audit evidence was appropriate or not. As far as sufficiency is concerned, sufficiency is something which will be required to be, as a factor of or as a matter of professional judgment, one has to apply. So whatever audit evidences he has gathered, whether they are sufficient or not. So it will depend upon maybe a sampling technique which the auditor has applied. It might be dependent upon the nature of audit evidence which is provided to the auditor. So sufficient and appropriateness both will go hands in hand, and one has to ensure that sufficient and appropriate audit evidence is obtained before any opinion is expressed. Now let's come to the audit risk. As far as audit risk is concerned, it's a function of risk of material misstatement and detection of risk. Now, risk of material misstatement can be at two levels. One is at overall financial statement level, and one is at the assertion level for classes of transaction, or maybe say account balances, or maybe disclosures which are there. And what will naturally will be there will be inherent and control risk, which we already talked about. Now, as far as inherent risk is concerned, it's more for probably the inherent risk will be naturally there for complex transactions or complex presumptions which are there. For example, if you have, say, a complex financial instrument wherein the valuation is done on the basis of certain presumptions, and so naturally, if you talk about the element of risk which is involved, there is a high level of inherent risk, a high level of risk which is involved. So inherent risk will be always on a higher side in a complex transaction as compared to a transaction wherein, say, you are complying with, say, accounting standard 11, wherein you are holding a foreign currency account with a bank abroad, and you have to translate that amount into Indian rupees. So there is no complexity in the transaction. So inherent risk is comparatively lesser. Now here the risk is that, for example, if you talk about, say, translation amount, the risk is that you may not be referring to the correct underlying data, and you are referring to, say, a website, or maybe just doing a Google search and using the translation rate. Now the risk of using unreliable data or unreliable information will be naturally be there, but it will be more in case of complex transaction and always lesser in case of a simple transaction. As far as control risk is concerned, it's a function of effectiveness of design, implementation, and maintenance of internal control by the management. So that is something which auditor has to test as to what kind of control risk exists. He has to test the effectiveness of the internal control which are implemented by the management of that particular entity. Standards per se don't distinguish between inherent and control risk, and they are kind of combined together. They are called as risk of material misstatement. But the auditor, while performing his procedures, he can bifurcate the risk into inherent risk and a control risk. Now let's come to the part of conduct of audit in accordance with standard, because that is categorically specified in SA 200. And as I said, SA 200 is a guiding path, or say mother of all standards. Now, first and foremost thing is that all the standards on auditing are mandatory, irrespective of type of entity. So when an auditor is undertaking audit, whether it is a trust audit, whether it is a company audit, whether it is a bank audit, whether it is a society audit, whether it is a partnership audit, LLP audit, proprietorship audit, anything, any type of audit, the auditor has to comply with all the standards on auditing. So all essays are mandatory, which are relevant to the audit. Now, essay is relevant whenever the essay is in effect, that is, it is already implemented. And secondly, the circumstances which are addressed by a particular standard, they are in existence. So just to give an example, suppose you are doing an audit of a standalone entity. Naturally, SA 600 will not apply to that entity. So that's why whenever we talk about complying with standards, the standards which are relevant for the audit will be required to be complied by the respective auditors. Second thing is that, which is very important, is that the auditor needs to have a complete understanding of the entire text of standard. Third thing is that you need not have to represent compliance with standard in audit report unless the auditor complies with 200 and other standards which are relevant with the audit. So as to ensure that to mention in its audit report. Next thing is that as far as compliance with standard is concerned, essays are concerned, complying with essays which are relevant to the audit objective are specified in every standard. Auditor has to use this objective to achieve overall objectives for the audit. And he needs to keep one thing in mind, that there is an interrelationship which exists between the standards. Now, he has to determine if any audit procedure, in addition to that, which is specified or required by the standard, is required or not. That is, he might have an additional audit procedure undertaken till the time he is sure that he has obtained sufficient and appropriate audit evidence. So as I said, standards compliance, that is SA compliance, is the minimum benchmark. One can go beyond that also, but the ultimate objective is that the auditor has to ensure two things: whether he has obtained the sufficient and appropriate audit evidence or not, and whether there are any material misstatements are there, or not. Now, in case, if compliance of a standard is concerned, unless the entire standard is not relevant, as I said, if you are doing, say, a single entity audit which doesn't have, say, components or, say, subsidiaries, or or a reporting structure, you are the sole auditors. Naturally, SA 600 may not apply to you. So complying with the relevant requirement has to be done unless the entire standard is not relevant. Second thing is that a standard specifies a requirement which is a conditional requirement, but the condition does not exist in that particular entity. Another possibility is that there is a departure from the requirement of exceptional circumstances. In the sense, you are not able to complete or fulfill the requirements which are given in the essays. So, in exceptional circumstances, you can perform alternate procedures and achieve the aim, for that requirement. Just to give an example, in pandemic, almost all the auditors were resorting to the alternative, procedures, but they ensured that the aim of standard was achieved. So there is no dilution of essay which is permissible in any circumstances. And in exceptional circumstances, the auditor can have alternative procedures performed. He may not perform the exact procedures which are there or specified in the standard, but he can have alternatives, found out which are equally effective. Now, in case, if there is a failure to achieve an objective, one has to evaluate if the failure is preventing the auditor from achieving the overall objective of the audit, and if need be, he can modify the audit opinion also. Now, it is very significant that auditor has to ensure that everything is documented. In the sense, the compliance of every standard is required to be ensured by the auditor. And just to put it in other words, your documentation or your working paper file or your documentation file should speak on your behalf. In the sense, your documentation should be so perfect that you should be able to demonstrate based on your documentation that how each standard on auditing was complied and how you have achieved the overall objective of the audit. And in case if there is a deviation from any standard, it might result in necessitating you to modify audit opinion also. So under say SA 705, you will require to modify the audit opinion. So this was all about the overall SA 200 framework, which forms the basis or premise on which all the standards are based. Now let's take a couple of case studies. So let's start with the first one, that the financial statements prepared are not in the Schedule 3 format for a particular company. So the management of the company is representing before the auditor that they have complied with all the accounting standards, but the format in which the financial statements are prepared, they are not either into Schedule 3 format. So just to give an example, suppose say the structure of Schedule 3 is not followed. That can be one of the example. The second example is that even though the rounding off is required to be done for the figures at the time of reporting to say nearest 1,000 or say in multiples of 1,000, the financial statements are prepared in full figures. So per se, the figures are right, but the format in which the presentation is required to be made is not achieved. So accounting standards are complied, but there is a deviation from format. Now, what is the outcome of that? If this is the case, the auditor will require the client to prepare and present financial statements in Schedule 3 format. In case if the audit is adamant and he is not ready to comply with that, auditor has two options. One option is that he can consider withdrawal from the audit if it is permissible. Second thing is that he has an option to either withdraw from the assignment or to give a modified opinion if he is not willing to withdraw or if he doesn't want to withdraw from the assignment. The reason being, Schedule 3 is a requirement under the Companies Act 2013, which has to be followed. Let me give a couple of additional examples. Let me give example of banks. Let's talk about two types of banks. So first one is say there is a scheduled commercial bank is there, and there is an urban cooperative bank is there. Now, as far as scheduled commercial banks are there, the format which is prescribed in Banking Regulation Act is typically a vertical format. As far as urban cooperative banks are concerned, they are governed by Section 56ZL, which is again given in the Banking Regulation Act itself, which is a horizontal format. Now, suppose a cooperative bank prepares its financial statements, that is balance sheet and profit and loss account, in say vertical format, or vice versa. Let's presume that scheduled commercial bank prepares the financial statement in horizontal format instead of vertical format, which is prescribed. Then in that case, the auditor has to ask the auditee to prepare it in the applicable format. If the bank is not preparing that, naturally you should consider withdrawal from the assignment or to give a modified opinion. Let's go to the case study 2. You are doing an audit in a technology startup, and the startup is recording significant revenue from the new SaaS platform. But customer contacts, you find that the customer is loosely defined. There is no revenue recognition policy which is established at a startup entity. The auditor can do is that after going through all the procedures related to review of the audit evidence and things, the revenue will ultimately be deferred till the performance obligations are satisfied, and he will ensure that the revenue recognition I got disconnected. Let me just again reconnect it. Yeah, sorry. I'll just repeat that you are doing audit in a technology startup, and in that startup, the records show you that the significant revenue stream is from new SaaS platform, but the customer contracts are loosely defined or loosely drafted. So there is no formal revenue recognition policy. The contracts are also not supporting for any particular revenue recognition policy. Now, ideally, what should be the outcome is, ideally the entity should recognize the revenue, and the revenue should be deferred until the performance obligations are satisfied based on the customer contracts. And the auditor will ideally include this particular aspect in the key audit matters on revenue recognition. Case study 3, there is an ethical conflict in related party transaction. So the audit client enters into a large transaction with a company which is controlled by the CFO's brother, but it is not disclosing that in the relationship. Outcome of that is a remedial process for that is the auditor ensures that this relationship is disclosed in the financial statements and addresses that in the audit report. Case study 4, fraud risk in cash intensive businesses. You are doing an audit for a chain of retail grocery outlets that deals extensively in the cash, and you find that the internal controls are weak, and there is a significant cash deposit which are varying. There is a significant variance in cash deposit across the branches. There is a possibility, I'm just adding that point which I have not written, that while undertaking this audit of cash deposits and the internal control mechanisms, the auditor reaches a conclusion that there is a fraud, and it has been established by the auditor along with those charged with governance. Then what he need to do is, if there is a reportable fraud which is discovered, he has to communicate that to those charged with governance, and the auditor needs to ask the management to take a corrective action against that detected fraud. Again, remind you what we discussed, that as far as the fraud detection part is concerned, the detection of fraud is not per se the responsibility of the auditor. It is the responsibility of the management. But in the course of his regular audit procedures, if the auditor is able to find out or discover a fraud, he has to communicate that to those charged with governance, and accordingly, he needs to ensure that the management is taking a corrective action. Next case study, misstatement due to management bias. So an auditor is reviewing the valuation of inventory in, say, a mid-sized manufacturing company, and the management is insistent on using the prices which are abnormally high as compared to the market rates. And the presumption for that is the management is claiming that there is an upcoming demand is there, wherein there will be a shortfall in the market, so the prices are likely to be increased. So it's a kind of a contingent event, which one can call it. Now, in that case, the auditor should react in such a way that he has to ask the management to do adjustments in the inventory valuation, in the sense at the fair value, and the disclosures related to that has to be made in clear form in the notes on accounts. Now, in case if the misstatements are not corrected, naturally the auditor will be required to report that, and he has to issue a modified opinion. Next study is about the misstatement of balances. The management of a company is insisting that pure credit balances of debtors are netted off, that is pure credit balances of debtors, that is advance received from debtors. They are netted off against the overall outstanding debit balances of debtors. So counterparties are different. So there are different set of debtors who have given the advance, and there is a different set of debtors who are having receivables, who are having receivable outstanding. And this has resulted in an understatement of debtors by about say 50 crores. Auditor should ensure that the credit balances which are in the form of advance received from debtors are specifically stated separately, and only pure debit balances are reflected as assets of the company as per Schedule 3. So netting off is not permitted. One more, possibility is that you have both, corresponding parties same. So you have received advance from say debtor A, and there is a receivable from debtor B. But receivable A, you have received the advance, and there is a receivable from debtor A itself. Now, in that case, if the advance which is received is for a specifically for a separate project, then naturally that will be required to be shown as a liability and should not be netted off against the receivables which are outstanding, unless and until there is an explicit intention of the debtor to give certain amounts on account. So auditor has to see that on a case to case basis. So these are few examples and case studies. So before we go to question answer, let me just summarize it. SA 200 on a broader basis, it forms a basis on which all the standards on auditing are designed. It gives a kind of a guiding path for auditors to comply with the standards on auditing. It has certain definitions which are vital for almost all the standards which are set. And as far as SA 200 is concerned, the compliance of all SAs is mandated as far as any audit procedure is concerned or any type of audit is concerned. Last but not the least, all the standards are mandatory, irrespective of the type of entity, irrespective of the auditor entity also. So it applies to all audits which are undertaken by the auditor, and there is no exemption per se, which is given depending upon the size of entity or the nature of entity. When the standard is not applicable, the auditor has to document as to why a standard is not applicable, and there has to be reasons for that. So maybe there is a probability that a particular circumstances wherein the standard is applicable do not exist. So only in those cases applicability of standards may not be there, but otherwise all standards are applicable for all types of audits. So this was in a brief background about SA 200. So if any questions are there, maybe we can take questions from the audience.
Thank you, sir.
Yeah.
Hello. Sir, we have received some questions.
Yeah.
So I will read the questions and also
Sure,
put the
sure. Or
questions
you can
in
display it, or
chat
you can
box.
post it in chat box also, so that it will
Yes,
be
sir,
easier.
yes, sir.
Yeah.
So, sir, the first question basically related to audit documentation. Sir, when members ask how can auditor balance the detailed documentation requirement prescribed under various standards on auditing with the constraint of time and client cooperation, particularly in context of SMEs or time-sensitive assignments. And could you also share the best practice that helps to ensure compliance without leading to over documentation?
Yeah. I will answer this question. It's a good question and a practical one. There is naturally, prima facie, everyone feels that the auditee or the type of audit which I'm undertaking, I'm running short of time. I'm having, I should say, the client is not that cooperative, and there is a time sensitivity because the due dates are there. So the auditors are always under pressure. Now that's something which we always presume. Now what is essential is that if you simply read the audit report in detail, auditor gives assurance that all the standards are complied with. So that is the first thing which we need to keep in mind. At the same time, there are ways and means how to comply with the standards. Now let me give a practical example what one can do. One can prepare a basic checklist for every standards, and that basic checklist may be one pager, two pager, can be filled in by the respective audit team to ensure that before the audit is signed off, there is a documentation created to ensure and to, I should say, prove that how every standards on auditing which was applicable to that entity is complied with. So, for example, if you talk about, say, sampling related part, what one has to do is that as far as that standard is concerned, one has to document as to what was the premise on the basis of which the sampling was selected or the sampling technique was used, and that is a sufficient compliance of that particular standard. So the best way, to or best practice, I should say, to comply with standard is that have a checklist prepared, apply that checklist uniformly for all the audits, irrespective of the size of the audit, irrespective of your audit fees, irrespective of the time which is spent on these assignments. Second thing is that there are various tools, which are available in the market. There are certain tools which are even which C Institute is also making available to the auditors. Make use of that, but there is no replacement to or there is no alternative for not following a particular standard. Every standard is required to be followed. So that's how I will look at it.
And sir, the next question is related to how can an auditor effectively communicate to those charged with governance about limitations encountered in achieving SA 200 objectives without harming client relations?
Yeah. Let me just read that once. Yeah, actually, see, as far as harming client relationship is concerned, I personally don't think that when you communicate to those charged with governance, it will harm your client relationship. Now, how to achieve that is first thing is that the auditor should first, have a word with those charged with governance, make his point clear as to what is the objective of the audit. Now, as all of we know, actually, uh, as far as the audit of objective is concerned, the objective is very limited. The objective is to give an opinion as to whether the financial statements are giving a true and fair view or not. So that is the basic thing which the auditor at times has to educate to those charged with governance, that what is the objective of my audit. Second thing is that while achieving that objective, the auditor has to ensure that there is no biasness which is kept. In the sense, when you talk about, say, professional skepticism, or when you perform the audit or when you apply the professional judgment, you need to keep one thing in mind, that your job is to express an opinion and not to find out errors, or not to find out the frauds which are really undertaken, which are probably there. So your job is not for the investigation. So when you communicate, actually your language should be balanced in such a way that those charged with governance or the recipient of your communication don't feel that you are getting into an investigation mode. So the language in which you are communicating is very important. You need to have effectiveness in that. And ultimately, what you need to harp on is you need to demonstrate through your communication that your main target is to ensure that you're cleaning the financial statements in the real sense. In the sense, you are achieving true and fairness, you're achieving financial reporting framework compliance as far as the financial statements are concerned. So how you communicate is very important. There is nothing like harming a client relationship as such. No one will harm the client relationship just by communicating about an error which is found out. But to go a little further, actually, if there is an auditee, who is feeling that the auditor is constantly nagging him or finding the errors, and he's not ready to even change the financial statement wherein obvious errors are there, auditor has to ask himself as to whether he wants to continue with the audit engagement or not. There is always an option to withdraw from the audit engagement wherever it is required. So at a particular point, there is no point in putting your professional degree at stake by not communicating to a client, under the pretext or under the possibility of harming a client relationship. So harming a client relationship is an extreme thing. I don't think that a client who is professional will take it in that way.
Okay, sir. Sir, the next question is, uh, how do you suggest auditor effectively apply the risk assessment procedure under SA 315 and link them with audit procedure in high risk areas, especially when dealing with evolving business model or limited internal controls?
Yeah, I will just answer this in a nutshell because I'm sure that SA 315 there will be a separate session altogether. But
Yes,
let
sir.
me just try to correlate with that because I think it's a question is about how to link them with audit procedure in high risk area, especially when dealing with evolving business models or limited internal control. See, as far as these risk assessment procedures are concerned, first thing is that when you identify a particular area which is according to you is having a high risk, so there is a probability of misjudgment which might exist, and there might be a possibility of evolving business models related to that, and the audit may not have sufficient internal controls. Now, when you apply uh, the risk assessment procedures, first thing is that you need to many a times customize your risk assessment procedures based on the understanding of the high risk area, where you want to apply that process. So first and foremost thing to begin with is that wherever you want to apply the risk assessment procedures, you need to gather sufficient knowledge of that particular area, which according to you is a high risk area. Second thing is that you can always take help of auditors expert. You can deploy expertise which may not be possessed by you as auditor. So don't shy away from doing that. And second thing is that there is no concrete formula as to how to deal with evolving business, evolving business models or limited internal control. You have to deal with that based on the circumstantial, examples. So suppose there is an area of high risk, let me just, maybe give an example of a high risk area wherein say, there is a complex, instrument wherein the client has invested, let's say a perpetual instrument, and there are certain presumptions, based on which the value is carried out, and there is a subjectivity in those presumptions. Now, presuming that the amount is significant, it is a material amount, and which is going to impact your financial performance of that particular audit entity also. Now, here you can apply the risk assessment procedures, but you might be having an inherent risk in applying that because uh, the high risk is due to the I should say too many presumptions which one is making, for which there is no objective base, there is a subjectivity which is involved. Now in that case, you need to satisfy yourself as to whether the risk assessment procedures which you have applied and the outcome of that, whether it is sufficient according to you or not. If not, you have to find an alternative methodology to overcome that. That's why I suggested that you might end up in deploying auditors expert, and then draw a comfort based on that. If one auditor expert is not sufficient, you can add on one more services of another auditors expert also. So that's how you need to address.
Yes. So the next question related to how do auditor ensure that they obtain sufficient and appropriate audit evidence when client operates heavily through digital platform with minimal physical documentations?
Yeah, now actually this is happening in many microfinance companies or even the companies wherein e-commerce platforms are there. Now here actually what I will suggest is firstly you need to perform the procedures to decide about the degree of reliance which you can place on the digital platforms which have been launched by these respective entities. So you need to see that what kind of internal control mechanism which are enabled through the system. Auditor at times may not be a expert in IT field, so he may not be able to assess that risk. So ensure that you are deploying the services of auditors expert or the management expert before you really rely on the digital platform related data. Second thing is that once you test the digital platforms, from where you are relying on the data extraction, you need to firstly have a comfort level or a degree of reliance on that data maintenance, and I should say integrity of that, completeness of that. Now, in days to come, actually, the auditor has to escalate himself in terms of expertise to understand how the data maintenance is there for the digital platform, how the data can be ensured to be not manipulated over the period, the data integrity, data safety, and data completeness. These are the three things which the auditor has to first make himself comfortable with by following certain processes and doing undertaking certain procedures. Once you rely on that process, next thing is that when you extract the data and when you rely on the data which is available on the digital platform, second step is that you need to also validate certain transactions which are digitally performed. Just to give you an example, suppose there is a digital platform through which loan disbursement is made. So there is no physical interaction between the lender and the borrower. Now, what as an auditor you need to verify is that how the KYC compliance is completed, how the legal agreements are entered into using digital tools, maybe OTP based, or maybe there might be a digital signature which is applied. Thirdly, whether there is a management expert, like say a legal opinion, whether the auditee has obtained about the enforceability of that. So one has to draw circumstantial comfort based on type of data which is going to rely and the nature of business of that particular auditee as to how he operates and the effectiveness of the data and as well as legalities related to that. That's how one has to look at it.
So the next question is related to related party transaction, where member ask how to determine significant risk in related party transaction relationship and transactions.
See, I will just give a basic premise. When you are talking about related party transactions, or when your auditor is auditing the related party transaction, what an auditor will always try to draw a comfort or a conclusion is that whether the transactions were carried out at arm's length or not. Now, the significant risk, which is related to the related party transaction, is about whether the transactions between two related parties, whether they are at arm's length or not. Now, one example is that you can draw maybe data from parallel transactions which are undertaken from non-related parties and establish that to what extent the arm's length is really maintained or not. Now, as far as determination of significant risk is concerned, that confines there only. So, two, three things, whether the arm's length is maintained or not. Second thing is that whether a particular transaction was really required to be undertaken between the related party or not. What is the reason for that transaction? Let me give both examples. Giving examples of arm's length is very easy. So, it has to be at the price or at the value with which a transaction will be entered with the unrelated party. Now, second thing which is very significant is that you need to also go little deeper into nature of transaction as to whether the transaction was really warranted or not. So let me give an example, classic example. Many times, in typical in case of bank audits, those of who are regularly doing bank audits, there are related party transactions which are observed in multiple borrower accounts. Transactions are done just to inflate maybe turnover of a particular entity or maybe to regularize different entities accounts, which are all related parties. So auditor needs to also ask a question that why a particular transaction is really entered between the related parties. And all these things combined together is what we can call it as a significant risk, which are related to related party relations and transactions. So one has to be a little more professionally skeptical when one is overlooking into these type of transactions.
Okay. So it was the last. That was the last question, sir.
Okay.
So now we have completed all the questions that we have received.
Yeah.
So, sir, thank you, sir, for today insightful session on HA 200,
Yeah.
along with the practical case studies and taking all the questions. I would also like to extend my sincere gratitudes to each and every members for their active participation and engagement throughout the session, sir. So, thank you, sir, once again.
Yeah. Thanks a lot, Vivek. And it was pleasure to be here. And thanks to all the participants. And my apologies for not able to start the video. It was not working due to some technical glitches. Thank you, everyone. Thanks a lot. Have a
Thank
good
you,
day.
sir.
Thank you.
हाँ हेलो हाँ हाँ एंड कर दीजिए